Good morning. With us today is Leonard from ABSA Capital.
ABSA Bank.
ABSA Bank.
Not using capital anymore.
ABSA Bank these days, yeah. We're going to be talking ETFs. We believe that you brought 3 new products to market. You've got a host of ETFs already. Let's talk about these 3 new products that you're bringing onto market. There's you've got long names for them. New Funds Volatility Managed High Growth Equity ETF.
Yes.
There's 3 of them, right? There's the High Growth ETF, there's the Moderate Equity ETF, and the Defensive Equity ETF.
Yes.
What are the characteristics of these, and why did you see the need to bring these on?
So probably the biggest criticism that the active management industry has of the passive industry is that we don't do any risk management in our portfolios. And I think that's probably not unique to South Africa, but South Africa is a very specifically bad case of that because our benchmark indices have very high concentration to a very small number of stocks. So I think we looked at like 50% of the portfolio is in the top 10. It's even higher than that. It might be 70% of the top 40 portfolio is concentrated in 10 stocks. Now that's a very concentrated position to take for an investor, and it brings a lot of risk into the equation. So as a participant in the passive industry, we took that criticism on the chin. We said, you know what, the active management industry does have a point, and South African indices do have a lot of risk in them that needs to be managed.
Have they not tried to address some of those concerns, like launching those equally weighted ETFs?
Yes, that is a reasonable attempt at risk management. What you find is that often by applying a blunt instrument to an index, you end up with problems that you didn't foresee. So a very good example of that is what we have in the market now with our Swiss indices. The top 40 index about 20 years ago had a very high weighting in resource stocks. About 40% of the market cap of the top 40 was resource stocks. And asset managers said, I don't want to take a 40% holding in resource stocks, there's too much risk there. So what the FTSE JSE did is they applied a methodology called the Swiss methodology, which essentially only looked at shares that were on the JSE register when they were considering the market cap to include in an index.
Right.
And the reason they did that was because a lot of the resource stocks had dual listings. So they were big companies, but a lot of their market cap was held by foreign investors on foreign stock exchanges. And what the JSE did is they said, if we only look at the JSE register, that will downweight the resource stocks in our index, and it will make it a more appropriate benchmark. So that worked very well. It did exactly what it was intended to do, it downweighted the resource stocks. The problem was that along came Naspers. And Naspers is only listed on the JSE, and if you look at the structure of the Swiss index versus the ALSI now, Naspers has got a higher weighting in the Swiss than it has in the ALSI. So you went from a 25% weighting in Naspers to a 30% weighting in Naspers if you went from the top 40 to the Swiss. So these kind of strategies that are quite, I call them blunt, which is maybe a little bit unfair, that there are elements of risk that are going to creep in unless you're specifically managing risk.
Yes.
And that's what we've decided to do now with our new funds, is to specifically manage risk, because we think that managing risk in the short term or reducing your downside enhances your long-term performance. Because if you are able to lose less, you don't have to participate as much in the market to make a profit. If you lose 10%, you've only got to get 11% return to get back to normal.
Yes.
If you lose 50%, you've got to get 100% return to get back to a position of parity.
Okay, so these 3 new ETFs specifically address that, right? Because I see effectively the difference between them is a weighting towards cash, so you're naturally trying to control volatility, and for our investors, volatility really does speak to the range within which your return fluctuates.
Yes.
For a simple explanation.
Yes.
There's a mathematical formula behind that, but
exactly.
We're not going to go into that.
It's the speed and the size that your share price can change. That's how we like to think about it.
And that's what you're trying to control effectively through these new ETFs.
So it's a difficult one because, particularly for retail investors, because volatility is a very interesting measure. Volatility at asset class level is a very good way to allocate assets to maximize your return over the long term.
Sure.
Because high volatility assets tend to reward you relative to low volatility assets at asset class level.
Yeah.
So a very simple example, if you want to make the most money over the next 20 years, invest in equity and don't invest in cash, because equity is more volatile. It rewards you for taking that risk over a long period of time. The problem that you have and where it gets interesting is that the volatility within equity is a very good indicator of poor performance. So once you're invested in equity, if you have a basket of the highest volatility stocks on the market, they will underperform a basket of the low volatility stocks in the market.
Sure. Yeah.
Not only that, but if you look at equities as an asset class, when volatility spikes, there's a very good chance that it's going to lose value in the next day. So there's a very high correlation between high volatility and high losses.
Inverse correlation between equity and volatility.
Exactly.
Yeah. And so the way you managed it between these ETFs, I see, is that you fluctuate between high equity exposure, lower cash during times of low vol, and then reverse that. So higher cash component, lower equity component. So it is slightly more actively managed than pure passive management.
We trade these every single day.
Okay.
So not necessarily trade them, but we get a signal every single day.
Okay.
We've built in a buffer so that the equity allocation has to change by 10% or more.
Okay.
Because otherwise the costs eat away the benefit.
Okay.
So if we don't trade in increments of 10, so if it's a 15% trade, we'll trade the full 15%.
Right.
But if it's 9%, we're not going to trade anything.
Do nothing. Okay.
If it's 10%, we'll trade the whole lot.
Okay, so that's your trigger. So your trigger is that if volatility increases by a magnitude that would result in a 10% or more move in equity valuations, go and rebalance the
Yes, equity proportion of the basket, John.
Yes,
yeah.
Equity.
We trade the same day that we get the volatility trigger. And that it's very aggressive. We've got to use some algorithmic trading technologies, but luckily being within the bank, we've got access to all of those kind of things at a relatively low cost. And our back testing shows that it works extremely well. And we've been running a few accounts for some absolute return managers in synthetic format, so we write them as swaps. And those have also been working. They do exactly what they say on the box, and I think that's what gives us comfort.
Excellent. Well, I'm looking forward to it. When are these launched?
This will list on the 25th, and the feedback that we've got from the market has been very, very good. We're quite excited. But given the amount of uncertainty that's in the equity markets at the moment, you've got the elections coming up. You've got Donald Trump's tweets move the market. You've got stuff happening with property rights in South Africa. People are saying this might be a very good time to buy equities because it might be from a valuation perspective. But there's a lot of risk in the market that's making you concerned. And basically what this does is it takes away some of that risk for you. It says try and harvest the equity risk premium, but when that equity risk premium isn't there, rather be in cash, because you're going to have a nice safe asset that gives you some.
And you come with both options. That's kind of managed.
Yeah, exactly.
That's kind of managed. So you don't have to sit there as an investor deciding, oh, should I sell this and convert to cash or not? That happens automatically within the product. And the nice thing is that these will be included in TFSA.
Exactly. Yes, there's no performance fees. It's an index tracking fund. Absolutely, you can buy these new TFSA.
So talking costs quickly, and to wrap up,
yes.
What are which are total expense ratios for those who need to know?
Yes, they are a little bit more expensive than your benchmark index funds. The low volatility one, the conservative or defensive fund, is around 60 basis points, or 0.6%.
Per annum?
Yeah, per annum, and that's everything in. And these are projected because a lot of that cost is the trading fee. So if we have a relatively flat year, not a lot of movement in volatility, that will come down quite dramatically. The middle of the road, the moderate fund, is around 80 basis points, and then the more aggressive, the high growth portfolio is around 100 basis points.
Okay.
But as I say, we won't know what those numbers are until about 18 months from now. That's just projected what we think. If the market behaves the way it's always behaved, that's kind of where we'll come out. We are investigating ways of bringing that down. So using some derivative exposure, some other ETF exposure, because that does have quite a big impact on cost saving. For now, we're just going to roll them out, and we're going to tinker with them as we go and see how we can make them better.
Excellent. Well, good luck. I think it's a brilliant option, and just adds to the basket of choice that that investors have out there.
Yes.
So thank you very much, Leonard. Thanks for your time.
Yeah, that was sweet.
Cheers.
Cheers.
Coffee.